Welcome to a brand new explainer. Today, we're tackling something I know keeps a lot of us up at night. How exactly do you capture high equity growth without constantly stressing over extreme market volatility? It's kind of the ultimate balancing act in investing, isn't it? Well, today we've got the perfect lens to look at this through. Seriously, how do you grab that high growth without taking on wild extreme risk? It is the classic investor dilemma. Everyone wants aggressive growth, but nobody wants the roller coaster anxiety that usually comes with it. The secret here? It's actually not about finding some magic stock. It's all about structure. A very specific structural framework that exists right inside a highly targeted category of funds. So here's our roadmap for this explainer. We're going to define these funds, check out their historical performance, decode the actual risk metrics, compare some top peers, and finally lay out a real blueprint for your long-term growth. Let's get right into it. Starting with Section 1, defining large and mid-cap funds. Let's look at the regulatory blueprint behind all this. Okay, if you only remember one thing from today, make it this: the SEBI 3535 mandate. Basically, by law, these funds have to invest at least 35% of their total assets in top-tier established large-cap companies. Then they got to put another 35% into high-growth mid-cap companies. Why does this matter? Well, this mandatory rule means fund managers can't just hide completely in safe stocks when the market panics, and they can't bet the farm on volatile small companies during massive rallies either. It literally forces discipline on the portfolio. And that brings us to why this hybrid category is so brilliant. It bridges the gap. On one side, you've got pure large caps, great for stability, but maybe a bit sluggish on growth. On the other side, pure mid caps, fantastic growth, but crazy volatile. This structure, it sits right in the sweet spot. It trims off the terrifying extreme swings of a pure mid-cap portfolio, while giving you a much better growth engine than a plain vanilla large cap fund. Let's look at a real-world example, the SBI Large and Midcap Fund. This is a massive player with over 38,000 cores in assets. Look at how they tactically balance things. They maintain a really solid large-cap foundation at right around 41.6%. But then they lean just slightly more into mid-caps at 43.3% to really rev up that growth engine. They even carve out a modest 15% for small caps to grab some of those early-stage opportunities. It's just a beautifully balanced distribution, especially for conservative investors. Moving to Section 2, historical performance and volatility. So, how does this structure actually hold up when the market gets bumpy? The consistency here is honestly what makes it so interesting. The benchmark index for this category, the Nifty Large Midcap 250, consistently beats the pure large cap Nifty 50. We're talking across every major time horizon. Over a 3-year rolling period, it averages 14.5% compared to the Nifty 50's 12.6%. That structural advantage generates an excess return, or alpha, of roughly 4.5% over the long haul. That is a massive difference over time. But we have to ask, what happens when things go wrong, especially with the recent market volatility we've all been seeing? Well, during those bumpy phases, this built-in diversification acts like an automatic shock absorber. That heavy large-cap base puts a floor under severe market declines. And remember that 35% rule? Because the manager has to maintain that balance, they're automatically forced to trim the winners and buy the losers. They're essentially forced to buy low and sell high. It's a structure that keeps conservative investors insulated from those stomach-churning swings you see in pure mid- or small-cap portfolios. All right, Section 3, decoding key fund risk metrics. Let's translate some of that intimidating financial jargon into simple tools you can actually use. First up, let's talk about beta. You can think of beta as your fund's downside buffer. It just measures how sensitive the fund is to overall market movements. A beta of 1 means it moves perfectly in sync with the market. But here, we have a beta of 0.88. That means this portfolio historically experiences only 88% of the broader market's systemic swings. So, if the market takes a massive hit, this fund's structure inherently cushions the blow for you. Next is Jensen's Alpha. I like to think of Alpha as the fund manager's extra credit score. It basically measures the excess return they got above what you'd expect for the risk they took. For the SBI Fund's direct plan, we're seeing a positive 3.15%. That's a strong signal that the manager's active stock picking is consistently generating excess returns above expected market risk. They're not just passively riding the market wave, they are skillfully navigating it. Now, if we bring it all together into one snapshot, you can clearly see the fund's downside resilience. Look at the standard deviation, which is just your overall volatility. It's sitting at 13.66%, which is significantly lower than the category average of 17%. It also runs a lower beta. But here is the kicker. It maintains a higher Sharpe ratio at 0.80 compared to the average of 0.71. A higher Sharpe ratio is exactly what you want. It means you're getting better historical risk-adjusted returns. Put simply, you are taking on way less anxiety but still capturing highly efficient growth. On to Section 4, comparing top peer funds. Let's see how this defensive strategy stacks up against its major rivals in the exact same category. This is where things get really interesting, the raw returns. If you look at the 3-year and 5-year marks, peers like Banton and UTI show much more aggressive numbers. For instance, Banton is pulling in a massive 22.65% over 3 years, while SBI is at 15.72%. On the surface, you might think, wow, the SBI fund is totally underperforming. But hold on, remember our breakdown of those risk metrics? Those peer funds are operating with significantly higher overall volatility. The SBI fund, on the other hand, intentionally and strictly prioritizes long-term capital protection over those short-term aggressive bursts. It's a classic trade-off. Investing is always a trade-off, right? While the highly defensive SBI fund might lag behind a bit during a euphoric, raging bull market when mid and small caps are just flying, its benchmark-aware large-cap core is what ensures you are heavily protected during sudden, brutal market drawdowns. It's not a shortcut to the highest possible short-term returns. Instead, think of it as a really reliable vehicle for steady, multi-year compounding. Finally, Section 5, Blueprint for Long-Term Growth. Let's map out how beginners and veterans alike can use these metrics to really assess long-term capital growth. Because these funds actively blend stability with high growth, they really do need time to work their magic. You realistically need a minimum of 5 years just to smooth out the initial volatility, but ideally, you're looking at a 7 to 10-year horizon. This is absolutely crucial. Giving it that time allows the structural advantages of that 35-35 rule to actually outpace the fund's costs and taxes, safely carrying your portfolio through full market corrections and all the subsequent recoveries. So, to wrap this all up, by blending established corporate giants with high-growth mid-sized challengers, this category beautifully solves that classic growth versus risk dilemma. It comes with built-in regulatory discipline, generates amazing risk-adjusted returns over time, and serves as an absolutely perfect core holding for your equity portfolio. Honestly, it's an almost completely automated sleep-at-night strategy for balanced wealth building. I want to leave you with a somewhat provocative question as you look at your own investments today. Does your portfolio actually have the structural balance to survive the next market panic? Do you have that large cap stability to weather a storm, combined with a mid-cap engine that can actually beat inflation? I really hope this explainer helped you master the powerful mechanics behind large and mid-cap funds.